Welcome to this episode number 94 of your next trade called today Mighty Globalists. So first and foremost, if you like those videos, please share with other people, put a like or put a comment. So let's start with a very busy week that we had with Europe, with the big German bazooka, but as well the weakness of the US stocks that keep on going. So let's start with this chart, which is the chart of the S&P against the Stoxx 600, which is the European index over the last 20 years or 25 years or so. And as you can see, the S&P has been outperforming Europe and the rest of the world like there is no tomorrow. So for the last 25 years, if you've been long the US and short the rest of the world, you have been doing very, very well. So for all of you or those of you who think that the US have been really struggling with the globalization of the economy, this is just a big lie. They have been the biggest winner of them all, of the world doing well, of the world opening. So the recent sell-off that we had in the equity market is not about globalization. It is mostly about valuation. This is mostly about tariffs. This is mostly about less visibility. This is about, pricing of 22 times earnings for the S&P. That is way above the average of 16 times over the last 20 years or so. So you could have the market going down another 10, 15, 20% and still the US market versus the rest of the world being expensive. So there is a reason to that, because the US have been really doing much better than the rest of the world. If you look at the growth, has been way above. We are talking 2-3% growth, when Europe, for example, has been barely having any growth. So there are reasons to that, but don't get me wrong. Don't be fooled by the headlines and the day-to-day noise that you have. They are really big trends. So let's look at the year-to-date asset performance. Looking at the S&P now down 2%, the Nasdaq 5.8%. And as we have been discussing over the last 2 months, the US market have been underperforming the rest of the world. We are starting with Europe very, very strong. So as we said, Germany decided to launch a 500 billion fund for defense and as well for a bit of infrastructure. Let's pretending that we're going to do a bit of infrastructure. So does Germany needs infrastructure? If you think about it, I want to believe that infrastructure actually in Europe are pretty good. So we should probably do a Doge in Europe, and the US should be doing the opposite, which is a bit of infrastructure. For defense, this is clearly needed. Europe has been under-investing in defense for the last 20 years, and I think the Trump administration is very right in pushing for that. So rest, so clearly US underperforming. What we see now is really the dollar down 4% on the year. If you remember, this is what actually the Trump administration has been looking for, a weakening of the US dollar for making exporters better as well. We saw that from day one, the Trump administration through Besant wanted the US 10 years coming down, and this is what is happening. So don't get fooled by the noise. Trump is doing stuff that he would like to do. Unfortunately, there is a lot of noise going into the market these days. Bitcoin down 8%, gold very strong, as we're going to see WTI down as well. So Trump wanted oil to go into the low 60s. This is what is happening for the time being. And, don't go against me. This is, I don't have, a preference for Trump or not. This is what is happening. Those are very factual. So what about the week-to-date asset performance? So this is important as well. We see the three big indexes in the US, S&P, Nasdaq, and the Russell down 3 to 4%. So we are still in the sell-off market. Europe has been flattish for the week, but this is the big part. This is the US dollar. US dollar down 3 to 4% for the week. So if you think about the DXY, this is 50 to 60% of the euro. So that explains a lot. But this is a move that, if you look on the weekly move, this is a move that we haven't seen for decades. Again, this is mostly due to Germany pushing and probably voting around the 20th of March for a big infrastructure defense expenses. So I would like to go into the year-to-date industry performance to look at what are the winners, so gold miners and gold. So that tells you a lot about this overall market, which is in the risk-off mode when gold is doing fine. That tells you a lot. Other end of the spectrum, we do have like software, we do have like retail and airlines, transportation, consumer discretionary. What are these? Those ones are very much cyclicals if you think about retail, airlines, transportation. So market is a kind of worried about the US consumer, at least over the last 2 to 3 months. But to me, the most important part is the week-to-date industry performance. It's not on the right-hand side. This is on the left-hand side. This is here. So what are the losers for the week? Regional banking and banks. So if you look at JP Morgan, I strongly advise you to look at it. It went from 270, 280 to 240 now. JP Morgan is more or less the second derivative of the US economy. When the US economy is doing well, JP Morgan is doing well, and vice versa. And when you have banks doing so badly as they did over the last 2 to 3 weeks, that tells you that the market is not only saying this is a question of valuation, but this is as well a question of how the US economy is doing, how the US consumer is doing. So the odds of no growth in Q1 or maybe even in a recession in Q1 are on the way up. So questions going forward, is it just a one-off because the market is adapting to the new tariff, the new administration, or is it more than that? But clearly the market is telling you, if you look at all those names, we are talking discretionary, we are talking cyclicals, we are talking bankings, and that is really not good. So that is the same on the sector performance. The only one that is doing okay, positive for the week is healthcare. Healthcare by definition is very defensive, but you do have, again, financial 6% down on the week over 5 sessions. So it's not only now, as we had before, only the momentum stocks, you know, the Nvidia of this world, the Palantir. Now it's spreading, it's moving from the high MOMO beta stocks to the more cyclicals and the financials that are down 6%. So really this is something to keep an eye on, because the market is telling you a different story from this week than it was the week before. So what about the rates? We're at 430 on the US 10 years. The most important part of these 10 years has been for Germany. So this is here, we are up 0.47 bips, so 47 bips, so it's 0.47%. So roughly 50 bips for the week. And what you see as well, this is the same for Italy, for Japan. So that has been so sorry, here this is the year to date, but here this is for the week to date. This is a massive move, but what you can see as well, it is spreading as well to Japan, to the UK. So again, Germany is really keen on doing now 500 billion. So for the last 20, 30 years, they have been telling the rest of the world and Europe that we should not be spending too much money, and the deficit should be less than 3% of the GDP. And now they are saying, because we need to put our defense back because of Ukraine, Russia, that we could be spending a bit more. So if you want to do that, by definition, you need to be selling bonds, you need to finance, so you need to be putting more paper on the market. So for the time being, the market is in the hoo-ha phase for the stocks, saying, you know, it's great because we're going to have more growth. Structurally, Europe has been struggling with growth over the last 25 years. You can argue that on one end, yes, this is a bit about, you know, because they are not spending enough. But on the other hand, I think this is more or less and more than less structurally, because Europe has been struggling for years due to regulations, due to having the right companies. You know, the tech companies are not in Europe. And if it's not because you're going to be spending on your infrastructure or your missiles that is going to be helping. So first reaction is, oh, it's great for the GDP, it's great for the growth. I think in the next 3-6 months, I don't have the timing, but the market will look at actually that the financing, the 10 years is now 40 to 50 bips. And it's not only for Germany, it's for the rest of Europe. So if you are in, for example, France, and now your financing is 50 bips higher than it was a week ago, you can make sure that in the next 6 to 12 months, the market is going to say, oh, the cost is way too high, they are spending too much. And when it is happening, it is at a time when most countries are having deficits, so that means a lot of paper. There is a bit of crowding out of paper, of bonds going into the market. So to me, that is a bit of an issue, more than a bit of an issue for the mid to long term, because at one stage, I'm pretty sure that the market will say, we don't want those bonds, and because they are bad quality. So Fed funds rates, to look at what the market is expecting in terms of the Fed cutting. Now we are almost at 2.5 cut for this year. We have been coming much lower recently. Why? Because the market think that the overall economy, US economy, is slowing, and as inflation is coming down as well, the Fed will be in the position pretty quickly to be cutting rate. The first cut rate, we are talking around the summer, July, so these are for the expectations. What about the VIX? When the market is in a sell-off mode, what happens is the VIX, the volatility is going higher. So we are at 25% on the 30 days, we are at 24%. As you can see here, when you are totally reversed like the way we are, that means there is a bit of short-term panic, and that means the cost of hedging your portfolio in the short term is higher than in the long term. So let's go now into the technical analysis, starting as always with the S&P. So this is the chart of the S&P 500, something that we discussed over and over. We said that we were short from 61.50, that we are using put spreads. So this week, as I said in the community, my first target was 57.25, because that was one of the levels that was pretty important. Not too much about the 200 moving average. I don't think this is 200 moving average is mostly about the headline, but you know, that was my first level. So I closed my put spreads, which were March and May, for very nice gains. So what's going to be happening going forward? So if you look at what has been the sell-off, what has been the size of the sell-off, we are talking from highs to lows 8%. So if you've done the 4x4 video series, and some of you did it, you do know that, you know, if you are looking at the market, most of the drawdowns ex recession will be between 5 to 12, 13%. So on average, we are talking 8 to 10%. So these days, what we have is a drawdowns, a sell-off that is no recession. If you go into a recession, guess what? Those drawdowns will be much, much bigger. And we are talking drawdowns that could be between 25 and 50%. So far, what the market has been pricing is more or less, you know, a bit of a hiccup in the trajectory, in the long run trend, and we have been only selling off by 8%. If we get confirmation of, you know, this slowdown, which has not been confirmed actually by the ISM manufacturing services plus the NFP so far. NFP is a lagging indicator. If you look at the ISM manufacturing and services, they are still doing fine. So as a leading indicators, they are doing okay. But we are in the range for the normal drawdown. What about the Nasdaq? Nasdaq, due to the high beta, has been selling off a bit more. That is totally normal. And as you can see, this is the chart of the Nasdaq. So we are bang on the support. So very interesting chart that are telling you this trend is still the same. So I'm not lying. This is what we have. You can look at the week before, 2 weeks before. That has been the chart. So very important point. I want to go now into a name that we mentioned last week and to tell you that technical analysis is helping to get entry level. So this is Costco. Costco came with their earnings on Thursday after the close. This is the same chart as last week. I was telling you there has been the trend, and you know the risk reward if you are buying was not that great in the middle. Now we tested the support, so really it helps. Finally, I want to be looking at Europe. Why? Because the euro dollar, and that has been the big move, as we said, 4% up for the week. That has been a massive, massive move that started with the German decision. As you can see, most of the people that were talking for the parity on the euro dollar have been absolutely destroyed. That's interesting. I want to look at the Euro Stocks 50. I'm short that one, which is, you know, I'm short a bit below that level. I think the market is in consolidation phase. Most of the big news have been priced in. So my bet is, it should go a bit lower from here, or at least that's what I'm expecting. DAX still very strong, but again, we need to have the vote going on, so that is where I keep my eyes on. So let's look now at what happened for the week. So we had, as we said, the German bazooka, big investment that was announced. Every single day you're gonna have noise from Trump and its administration. To be honest, I don't think that should be an issue. You should get used to it. If you've been trading between 2017 and 2020, this is what has been happening most of the time. But I think what is important is we went from 3% growth expectation between November, December, mid-January. So as you remember, everyone was saying, oh, growth in the US is going to be fantastic. We're going to be doing 3% GDP growth. Earnings are going to be growing by 10 to 15%. And now we're completely reversing. We are going into recession. So don't go from one end to another. I think that it's very excessive, what the market is trying to price now. But I don't think this is only a question of growth. This is a question of valuation. So when you do the 4x4 video series, when you do the mentoring with me, you look at what you paid. That means valuation. And again, S&P 500 is trading for this earnings year between 21 and 22 times. If you look versus history, that is pretty expensive. More importantly, this is expensive when the US 10-year is at 4% and above. So what does that tell you? That tells you, about the S&P selling off almost every single day. And it's almost the same pattern. You have the overnight, then you do have like a bit of sell-off during the session, and then you bounce a bit. So a lot of options are still involved in that play, and I'm going to be looking later at where to look for those options. So the German bazooka, this is the move for the German 10 years. We are talking 30 bips, 0.3% on one day. That is something that we haven't seen since 1991, I think. I was not trading at that time. I was still, enjoying my life and being 15, but that has been the big move. So we do have these tariffs that are the same as the daily Trump. And finally, I want to give you this chart that is an index that is used by Goldman Sachs, which is the US long-short stagflation, which is being long the company that will benefiting from stagflation, the ones that will be not through the shorts. And as you can see, since mid-January, okay, so this is election, we have the election move where investors were pretty much saying, oh, it's great, we're going to have Trump, and we had a big consolidation, and then we reversed everything. So all the Trump elections trade, and we can be looking at the same for Tesla and some other names. You can be looking obviously at the S&P, which we traced all the gains from the US elections. We are back to this level. So again, be careful and only looking at the noise and listening to the noise, because we can't be going from 3% growth to a big recession. So what about the catalyst going forward? We do have like a bit of inflation with CPI and the PPI. So most recently, this is how the market has been reacting on CPI day. So this is for the S&P 500. Greens have been pretty strong. We didn't have much of a sell-off most recently. If you look at the ISM manufacturing and services that we share on the Discord community, the comments, many of them were about tariffs. So the market is pretty much worried about tariffs. Is this just for the next 2 to 3 months? And when we settle from April onwards, the market will be digesting? That is one of the big questions. So CPI, PPI, we do have as well the Bank of Canada rate decision on Wednesday with the 25 bips, more inflation on Monday. We have the small business optimism on Tuesday, which is important. We have some bond supply coming, so 58 billion, 39 billion, and 22 billion. We do have as well no Fed speakers, FOMC blackout period, so don't expect any headlines from Powell or so. Why? Because in 10 days' time on Wednesday, in 10 days, we're going to have the FOMC meeting. So that means for the next 10 days, the Fed speakers are not allowed to say anything. Another thing that I want to show you is the S&P total put. So if you look on the left-hand side, this is the number in blue the number of SPY puts that you have most recently. And as you can see, as the market is dropping a lot, you have seen a big increase of the SPY puts. So that's the reversal of the playbook when we were seeing calls and calls that were bought by the market. So that could be interesting actually. So if we start to see retail traders going into the playbook of buying puts, because the gamma that played on the way up could be playing the same on the way down. All of this tells you that there is higher volatility. For this week, we are expecting plus minus 2.6% move on the S&P. So that's roughly, 150 points, something. That tells you that volatility has been on the way up. So expect a lot of tariff headlines. Again, a lot of noise. I think, the underlying is you should still be looking at the economy. The economy is probably going into low growth. Question is, are we going from low growth into recession? Finally, not that many earnings. We do have like a bit of interesting name like Adobe, like Oracle, and Ulta as well. But there are some conferences that will be starting as well. So companies will be talking with brokers, with banks, and they will be sharing their views and how the business has been doing over the last couple of months. So that should be something interesting. Finally, as always, 4x4 video series. If you want to have the same process, if you want to have a real process, a professional process that I've been building over the last 25 years, mentoring, one-on-one sessions that we do through Zoom. I have many people that recently joined. I don't know because if it's due to the sell-off, but if you're interested, you should send me an email pretty quickly to book your place for the next 2 to 3 months. Finally, we have the trading community on Discord where we have a big free channel. Otherwise, if you want to subscribe for $74.99 per month, you can have access to 30 channels when we grow from special situation to all the sectors. We give research on single names. So and we share as well macro data and macro spreadsheets that are been built from the 4x4 video series. So any questions, you can reach me at Greg@Dupont Trading. And this is it for me for the week. Have a good trading week. Bye-bye.